think rents could drop 25% in New York, office rents.
Barry Sternlicht foresees a collapse in Manhattan real estate.
I think a third of hotels in New York City could go bankrupt.
He says the coronavirus pandemic is just finishing what Amazon started.
Retail is like the 9/11. It's a hurricane.
And explains why billionaires like him are fleeing America's blue states.
At some point you say, that's enough. I don't have to be here.
Barry Sternlicht is one of the world's top property investors. At the age of 31, he started buying up bad loans in the S&L crisis. Now, 3 decades later, his Starwood capital manages some $60 billion in assets. Sternlicht doesn't hold back, and politics definitely play a role in his business decisions. I'm Erik Schatzker. Welcome to my front row interview with Starwood Capital CEO Barry Sternlicht. How does the pandemic reshape the real estate landscape? A little, a lot, dramatically?
It's very clear that most likely rates stay low for a while. So that has to inform your long-term view of, will you invest in property? And that's what kind of property. So there are the major food groups of real estate, like hotels like airlines and cruise ships, the most impacted. We were asked to close our hotels in major cities. Then they shut down domestic and international travel. International and domestic was cut back. So cities like New York or Los Angeles, Chicago, New Orleans, big meeting cities with big convention centers, that business can take a while to come back. And until they turn on international air travel, you're not going to see a big resurgence in those hotel markets. On the other hand, drive-to markets that are mostly domestic, and even weekend business where people can get to a hotel on the weekend, that business is coming back very quickly. And in the drive-to markets and the low-end hotels that are more like surrogate apartments, we're running 84% occupancy in a 200 hotel chain, 24,000 keys, and yet our hotel in Los Angeles is shuttered. Our hotel in New York has no demand whatsoever. And in Miami, where we reopened a hotel recently, for the July 4th weekend, we'll run 70% occupancy, and everyone is driving. Vegas was the hotels open to California drivers and other people who are driving the market. Most people aren't flying. So it'll be a while, and that's hotels. They'll be better only when we probably have a vaccine and air traffic returns to more normal levels. And groups, businesses are willing to book conventions. And what will be the long-term impact of Zoom video on group meetings? Well, I don't know how they certainly will impact the rate of growth, and perhaps they'll cut group travel for a while. So office, I'm not worried about. Office tenants are paying. I don't think people enjoy working from home. We were talking off camera about this. I think people are ready to get back to work. Work is more than just coordinating or management by walking around for a leader, or it's a social event. It's like going to the theater. You go out, you want to see your colleagues, find out what they did. And I don't think there's anything that makes up for a face-to-face contact. So I am personally not worried about office, even though companies may take less space. About 20 years ago, we started to densify office. We were using almost 300 square foot per person in office, and it got down to 225, and you're probably going to go right back the other way. So a company could take 25% less space, but go back to the 300 square feet per person, and you'd be in the exact same place. I'm not really worried about office to speak of. There are geographies like New York City, I'm worried about office, but really for other reasons. And then retail is like the 9/11. It's a hurricane, and it's everyone who didn't have an Amazon Prime card now has one. My 86-year-old mom figured out how to order a thermometer online and have it delivered the next day for free. And even in China, Alibaba got the rest of China on their platform. So I think the convenience of online shopping and e-commerce, and some of the retailers, when you saw companies like Williams-Sonoma report earnings, and they did really well, they have really upped their game online. And I'm an unfortunate customer, so I get bombarded, I think, 5 times a day with a different order from Williams-Sonoma or Pottery Barn or any of their companies. I think great physical retail will survive. Rents may not be what they were. Really difficult asset class today. And I'm not talking about a Walmart store. I'm talking about the shopping centers and main streets of America that are really losing tenants left and right. And you've seen the record bankruptcies this year of retail tenants, and it's going to get worse. The other asset classes like apartments and single family rentals, very, very good, very solid. And really the long-term impact will be, how do we recover from this pandemic? Do we get back to 9% unemployment at the end of the year, and then sort of drifts down to 5? So incomes are not hit. They may grow more slowly, but incomes continue to rise for the general population. Then the housing market will be fine. If we get stagnant and we keep 20 million people on unemployment, which I don't think will happen, you could see a decline in incomes, and it would affect housing prices and also rents. Right now, you're not seeing that. So I think different asset classes in different cities and different geographies are all impacted differently by the pandemic.
Why do you say you're worried about New York? Is that the market that faces the toughest climb out of this crisis?
Yeah, so New York took a 1-2 punch. It really, obviously was the epicenter of the COVID experience for Americans. It was the worst hit region of the country. And I think when people in New York look around the country and they say they don't understand what they're doing in Georgia or in Iowa or other cities, some states that barely shuttered, they're looking at it from their experience in New York, which was pretty bad. And I think also the rioting after George Floyd scared a lot of New Yorkers. So I think people realize that the pandemic seems to have been spread perhaps by the density of New York and the need to take public transportation. And it was a scary time for New York. I think executives are now also looking at all of the other factors that have kept them in New York, including their tax rates. And I think in general for Starwood Capital, my private firm, we've really favored recently the investing in the red states, not because it's not a political commentary, but the red states are growing, whether it's Florida or Texas or Tennessee. The states with lower taxes are just adding people. The states with higher taxes are actually losing people, and they're voting with their feet and their cars. The move outs from New York and New Jersey, I think, versus move-ins are like 60% of people are leaving versus 40% coming, and that's just recent data that I saw. So even the Californians are beginning to leave what was regarded as a very high tax state for places that like Wyoming and Nevada, which are low tax states. So I think as this is a vicious cycle that gets worse, as if they raise taxes, more people leave, and the social burden of those that are less fortunate falls on an ever smaller revenue base, and they can't cover it because you have unions you have to support too. So the services of the city get worse, the city gets dirtier, the police show up less often, and it's a negative cycle. I think New York is close to the tipping point personally. I think I love New York. I grew up in the area, but things can change. And, kicking people out who bring jobs isn't a smart program for New York.
Tell me more about this thesis on New York. Why is New York at a tipping point?
So, New York, taxes are probably going to go up in any administration on the wealthy. And I think New York has such incredible social burdens on its infrastructure and its population that they really need to raise taxes. The city's running a budget deficit. And so I think between the pandemic and the rioting that followed the George Floyd incident, I think people have changed their attitude a little bit about New York. The last 2 or 3 years of growth in New York hasn't come from the old banking system and finance. It's really been telecom and technology. Those companies that are dominating the stock market today that are 76% of the growth in the S&P this year, whether it's Amazon or Apple or Facebook, they've been very active. Google in the New York City office market, Google's gobbled up a couple million square feet. They bought the St. John's terminal. Amazon bought the Lord and Taylor building on Fifth Avenue just before the COVID crisis. And then during the COVID crisis, Facebook stepped up and took over the Farley building at Union Station, at Penn Station, I guess it is. So, they've been taking a lot of space. I think they're the most likely tenants to slow down. If they're young people, which is why they're coming to New York for talent. They came to the city because young people want to be in the city and they want to recruit them. If they don't want to stay in the city, and we'll see if it lasts, but right now the young people are saying, maybe I should go to the countryside. I think, the growth of technology companies in New York may slow down dramatically. And it really is about quality of life for these millennials. And I think at the moment, my little survey of my own kids, they're like not that excited about being back in New York. And that's echoed across our associates and analysts too. That's funny. The adults are going back to the city. That the kids don't want to go back.
What's that all going to mean for valuations, and what does that mean for
it's not good.
An investor like you? So let's like paint the picture. Next 3 to 5 years, and what does Starwood Capital do?
I think rents could drop 25% in New York, office rents. I think expenses could go up 25%. You could see office values drop 40% because of that. Pressure on real estate taxes in particular that can't be passed on to tenants. Rental apartment rents right now, you can get probably an apartment for 25% less than you could pre-COVID. Landlords are desperate to retain and attract young people. And they're thinking, I don't think I want to renew my lease. Maybe I should leave New York. So I think, I do think that the mayor of New York is playing with fire. And I'm not sure it's going to work to his long-term advantage. I don't think you can try to make New York miserable for the affluent and expect it to be successful for everyone. So, and that was my political comment for this interview. So I think New York's an incredible place, has amazing energy. There are other incredible places in the country, or they will be incredible when all the New Yorkers populate them. So the former New Yorkers populate them. I've gotten tons of calls from friends in the Northeast, particularly New York, who want to move to Florida. And that's really become quite the thing. And it's more than, they just don't want to live in the city. And right now, and we'll see. I think the city is, it's probably going to be the toughest office market in the country. And it will be New York. And
saying something.
Well, maybe not worse than Houston, which hasn't had a good streak in 25 years. So, but yeah, I wouldn't expect that New York will be, the one thing going for New York is every foreign investor wants to own New York. And it's kind of what they do. Like everyone has to have a building there. So, and they may not be attuned to nuances and patterns that are changing. So, but whether it's apartment rents that are down, there's one other thing in New York, right before COVID, the legislature passed regulations to regulate more apartments. And they did it in such a way that for an owner of rent controlled apartments, if you actually invest in the property and fix it up, you get no return on the capital. You're not allowed to charge anything for the money. So in your travels, I'm sure you've been there. I was in Mumbai, formerly Bombay. And that's the actual impact of this kind of rent control. Owners don't invest in the properties, and these former beautiful properties deteriorate and look like slums. And that was an ill-thought legislation in New York. That whole populist movement of not allowing people to raise rents or earn a return on the money that's necessary to fix up a property, that's not a good long-term strategy for any community. And you're seeing it replicated in California and other cities of the country. And again, that's not really, they don't do that in the red states. They're more capitalist, and they sort of let it go where it goes. And the biggest mistake people make in the blue states is how expensive they are because of the union, the union's lock on labor. And we constructed a building in New York a couple of years ago, and we bid out a contract to renovate this building, union and non-union. And the bid for the union contract was 91 million, and the non-union contract was 54. So we took the non-union contract, but in most cases you have to go union. And that's why housing is so expensive and everything's so expensive in New York. It's not because developers are making a fortune, it's because the unions are charging a lot, and it just makes everything more expensive. And you don't have that situation in the red states. So housing is cheaper, things get done faster. And I think that's benefiting the Texases and the Floridas and the Tennessees and the Seattles, the Washington states, I should say. Seattle's not a state. And it's accelerating. It's not turning the other corner, it's accelerating.
Barry, every CEO I talk to says that he or she sees a future with less corporate real estate, right? My people are going to work from home. I can have hot desks. We can swap them in and out. Doesn't sound to me like you're a big buyer of that thesis.
Not really.
Why not?
Again, they may take 75% of the space, but they're taking 25% more space for the people who come to the office. So the other thing you mentioned about New York, we should have mentioned at WeWork. I mean, WeWork is
sure. Co-working. What's the future of that?
Well, WeWork was New York's largest tenant, right? So They're the largest tenant in New York, and they won't be growing anytime soon. So they'll probably be giving up space. So, I actually think that shared office space makes sense. I think it's a real asset category. I think it's a real company. I think the valuation was all wrong, and I think they do too, since they wrote it down 95%. But I do think it's a real business. They do make money in New York, and they make money in other major capitals, real estate capitals of the world: London, Tokyo, Paris, Singapore. They make good money. They didn't make money in tertiary cities where the real estate was cheap and nobody really needed a WeWork to get into an office in St. Louis really quickly, or in Bangladesh. But their clients asked them to go to all these places, and they were going to be a global firm, and they were told to grow. So they grew, and they grew at a pace that was really hard to do.
Aren't they asking you for forbearance right now?
Not everywhere. We have them as clients in 7 or 8 buildings around the world, and they paid us in 7 of the 8. The one they don't want to be in, they actually, we want them out of. So because they're paying a rent that's below market today, we think, so we're okay taking the space back. In a way, I mean, if WeWork could have bankrupted itself, it could have gotten rid of all the money losing locations and simply focused on the ones that were doing great. They're in a building in London that we own, and they charge tenants the equivalent of about 160 pounds a foot, and they probably net 130 after they make it a WeWork. They pay us like 65. So there are pretty good margins in that business, but there'll be a big shakeout in the shared office space. Most of the smaller guys will die, they'll consolidate, and it'll always be a niche product in the office space.
Given what you do, you have to have a view on the future of retail. What is it?
What's the next question? Yes, I would have been a professional tennis player if I'd been good enough. Retail, I think physical retail will stay around. I think, when you're looking at a retail location, if you're an investor, you know a tenant, you may not know the rent today. The tenants have, what few tenants there are, have all the leverage. And so if you'd like to ask $100 a foot and they say, we'll take it, but we want 50, and you're buying that at 10 times cash flow, that if you went 10 times 100 or 10 times 50 and your debt was 50, you're now bankrupt. So your asset's worth half of what you thought it was worth. It's very hard to underwrite retail today. The best retail assets, even what you'd call the best, let's say it was on Fifth Avenue in New York City or on Bleecker Street in the Village. I mean, if you've been on Bleecker Street or Fifth Avenue, there are a lot of empty stores because they were bought for rents of $10,000 a foot. And today the tenant's like, $3,000 a foot. If he pays $3,000 a foot, the property's going back to the lender. So it stays vacant until he hopes somebody shows up at $10,000 a foot. And rents didn't move like that on Fifth Avenue. They soared through the ceiling, and same in the Village and in Soho. So I think the internet brands, the strong brands of the internet, they find, and I know it's true because I'm on the board of Estee Lauder for 15 years or 16 years, that the physical helps the digital. And they work together, the e-commerce platform and the physical location, they reinforce each other, and your sales, the digital only companies often don't get to scale in retail, whether it was Bonobos, Warby Parker, Allbirds. Warby Parker now has 120 stores, and their stores are very successful. So there are certain tenants, they'll be super picky where they go. And the nation probably has, a mall is kind of an outdated concept to some extent. I mean, we own some, it's been really hard. Our tenants keep going bankrupt, even if we have a good Pier 1 or a good Forever 21 or a good, so we have a great, like JCPenney just announced a round of store closings, as did Macy's. None in our malls. Our malls are safe. So they're not the worst of the malls, right? But it's really hard. Apple's decided that they are the biggest draw in the mall, which they are. And so they say, you should pay us to be in your mall. Well, that's not what you modeled, right? You didn't model that. So now, it's very hard to value these assets, and it's going to be a long time until that landscape is reached equilibrium. But
how much of that is pandemic and how much of that is Amazon?
The pandemic is Amazon. I mean, Amazon was a pandemic to retail. They practiced what to me amounted to predatory pricing. They were selling product below the cost of its total cost of goods. And in industrial chemicals or in steel, you can't do that. It's called predatory pricing. Amazon built their whole company on predatory pricing. So, and supported by their cloud business. So I'm not a fan. I'm not a fan of this kind of technology. I'm a fan of, I think it's convenient. I think Americans should understand that when their main streets go dark, they did that. For me, it's $1 trillion company. It's like enough is enough. Maybe we should have some, capitalism should have some regulation behind it. You hit a hot spot. So that's a hot spot. I like my main streets. I like charming America. I like mom and pop shops.
You started Starwood Capital back in the S&L crisis, buying up bad loans. Is there going to be another wave of distressed assets coming out of the pandemic crisis?
Yes, there will be.
When? Nothing started to trade yet.
Well, the Fed encouraged the banks to work with their borrowers through the pandemic. And, you know, at first I was kind of upset because they were saying, we'll work with you. And they were saying, just pay back my loan. So they were saying, because they didn't relax the regulations on the banks, they just told them, they encouraged them to be creative and work with their borrowers. You know, it was no fault of ours when the Miami city government called us up and told us to shut our hotel down. And we had to kick 100 people out of the hotel that had booked it through the pandemic. We couldn't even keep them. So then we have a loan on the hotel, and what do you tell the lender? You know, it's like, I'm sorry, we were forced to close our hotel. Well, who's going to pay the debt service? Not the city of Miami. So I think hotels comeback is going to be slower than I thought. I mean, we thought we'd have our hotel open in LA in June. It still isn't open. They won't let us open the hotel. So, you know, we had reserves. We have the ability to cover them. We're a large borrower, but the average mom and dad owner is going to run out of ammo to support their property. So I think a third of hotels in New York City could go bankrupt. It's going to be a show. I was going to say one kind of show, a famous kind of show, but it's not. I can't say that on live TV. So it's going to be ugly. And big hotels like in Orlando, hotels, the meeting space hotels, the big meeting houses. You tell me when big businesses are going to force their clients or customers or their employees to go to a group meeting in Vegas or in New Orleans or in Orlando. And there are big hotels built around that business, and they won't do well. Just as an aside, high-end resorts are fine. I mean, like I was talking to the owner of the Amman resorts, which are, you know, $1,000 a night and more, and they're all booked. So people they want to get away, and if they have the access and ability to get there, they're getting away. So the very high end will be immune. It actually might even be better. So
you're one of the wealthy financiers who left the Northeast to move to Miami, if I'm not mistaken, largely for tax reasons, Barry. I know the Connecticut governor, Ned Lamont, has asked you what it would take to move back. What would it take?
I need a change. I grew up in New England, and it wasn't just tax reasons. Actually, I had a business down there. I have 300 people in Miami, so I moved down, and that was where I chose to go because I had an office.
But you think other people are going to go there for tax reasons? Well,
most people go there for tax reasons now. You know, I think it's an easier life. You know, and if you don't have small children, you're not dealing with the school systems or anything like that. So it's more the retiring baby. I'm an edge of the baby boomers. So I'm the last to go because I'm at the end of the baby boomer generation. I mean, in Connecticut, I think the blue states have to change their attitudes. You know, the facts are the wealthy pay half the taxes, and it's usually in New York City, I think it's 70 people pay 50% of all the taxes or something like that. They should be hugging these people, not kicking them out and yelling at them. The average person doesn't pay taxes. So it's really, in Connecticut, you know, the ultimate was, of course, David Tepper in New Jersey. When he left, he created a $176 million hole in the New Jersey budget. And they had to cut teacher salaries. So maybe they should have negotiated with David Tepper to stay in the state, because that would be just like he made a company there. And David's a wonderful guy, and he gives back a lot of philanthropy to New Jersey and does amazing work with the homeless and other areas of need. But I think Connecticut, you know, it had a tax advantage over New York. That's why it used to have no state income tax. And then Governor Weicker put in a small one, and it just kept going up. And the state has tilted in the wrong direction. Governor Malloy, who was the predecessor to Governor Lamont, who I went to high school with, he was like, I'm gonna balance the books. Well, he was a Democrat, and he caved to all the demands of different groups, and the budget deficit never got fixed and got wider, and he kept raising taxes. At some point, you say, that's enough. I don't have to be here.